Hello, and you are welcome to Global Business Insights, where we bring fresh analysis and keep you up to date on all you need to know in the world of business. The main stories. First, we look at the South African economy as the president delivered his State of the Nation address, declaring that the worst was over with load shedding. Then we look at Google launching Gemini, which upgrades the old Bard and pushes artificial intelligence applications to new levels. Also, Ralph Lauren shares yesterday jumped 16.8% to a 9-year high after the luxury retailer's earnings beat Wall Street estimates, also helped by demand in China, which offset softer sales in North America. And yesterday we saw Brent crude prices advancing 3.1%, marking the longest positive run since September for the benchmark. Traders are nervous as Israeli Prime Minister Benjamin Netanyahu rejected a ceasefire deal with Hamas and vowed to keep fighting. Today, oil prices are flat but staying on track for weekly gains. In early morning trade, Brent crude standard was under $82 a barrel. Then, of course, just in this morning, we got inflation, consumer price index data for Germany. Some good news there. Inflation came in at 2.9%. We start with South Africa, where President Cyril Ramaphosa yesterday night delivered his 8th State of the Nation address. He spoke on ending load shedding, strengthening law enforcement institutions, and the continued fight against corruption. He also said he will overhaul the nation's healthcare system and extend welfare grants as the country prepares for elections. Here is an excerpt from his speech.
The real tragedy of state capture was that it diverted attention and resources away from what government should have been doing, which is to grow our economy and create jobs. Over the past 5 years, we have worked earnestly to revive our economy from a decade of stagnation and to protect it from both domestic and global shocks. We have laid a foundation for growth through far-reaching economic reforms that we have embarked upon, an ambitious investment drive and an infrastructure program that is starting to yield results. Companies continue to invest. Thousands of hectares of farmland are being planted. New factories are being opened and production is being expanded. We are on track to resolve the most important constraints on economic growth by stabilizing our energy supply and fixing our logistics system. As these obstacles are removed, the true potential of our economy will be unleashed. We set out a clear plan to end load shedding, which we have been implementing with a single-minded focus through the National Energy Crisis Committee. We have delivered on our commitments to bring substantial new power through private investment on the grid, which is already helping to reduce load shedding. Last year, we implemented a major debt relief package which will enable Eskom to make investments in maintenance and transmission infrastructure and ensure its sustainability going forward. Through tax incentives and financial support, we have more than doubled the amount of rooftop solar capacity installed across the country in just the past year. We have implemented sweeping regulatory reforms to enable private investment in electricity generation, with more than 120 new private energy projects that are now in development. These are phenomenal developments that are driving the restructuring of our electricity sector in line with many other economies have done to increase competitiveness and to bring down their energy prices. Through all these actions, we are confident that the worst is behind us and the end of load shedding is finally within reach.
The South African economy has been held back by three fundamental issues that are not as easy to tackle. First is corruption and state capture, embedded in a more state-driven economy, which of course has crippled other vital sectors. Second is an energy crisis and persistent load shedding in an energy-intensive economy requiring a more competitive and private sector investment inflows, especially in the power sector. And thirdly is the ever-expansive and increasingly unaffordable public wage bill requiring public sector reform and fueling higher deficits and public debt. The latest S&P Global South Africa PMI showed it edged up to 49.2 in January from 49 last December, still in contraction. On the domestic side, firms reported a decrease in new business amid weak economic conditions, while on the external front, new orders from abroad also fell due to worsening global demand. Businesses also saw further headwinds on the supply side, largely as a result of the Durban port crisis. Is the worst over as crippling power cuts, volatile commodity prices, and a challenging external environment contributed to the country's weak growth performance? The IMF projected, after 0.6% growth in 2023, a slight improvement to 1% in 2024, down from a previous 1.8% forecast, and up to 1.3% in 2025. In other words, growth is seen at best not expected to improve significantly. The government announced the 3-year debt relief arrangement to help Eskom establish its commercial viability and mitigate the energy crisis, but more structural reforms are required to attract private sector investments. Additional far-reaching reforms, according to the IMF, are also needed to achieve job-rich, inclusive, and greener growth. These including reducing barriers to private sector investment, addressing structural rigidities in the labor market, and tackling crime and corruption. South Africa's elevated public debt, one of the highest among emerging markets, also limits the government's capacity to respond to shocks and meet growing social and development needs, even as high food and energy prices is also raising inflation expectations. I agree with Ramaphosa that corruption is an underestimated source of vast leakages that makes nonsense of intentions to fix the economy. He called it a diversion. I think it's worse than that. And if not comprehensively tackled, the foundations required to realize the potential of the most developed economy in Africa will just elude South Africa. My sense is that the dominance of the ANC needs to give way to truly multi-party democratic institutions to strengthen checks and balances. The worst may be over with load shedding, but load shedding is a symptom of a broader economic disease requiring more structural reforms and bolder new paradigms that can take an economy that could be doing so much better forward. We've all interacted with chatbots, sometimes helpful, sometimes frustrating, but the AI landscape is changing. Now imagine a digital assistant that goes beyond simple question and answer. Meet Gemini. I subscribed. You get 2 months free, so you can decide if you really want to pay $19.99 a month after that. I asked to suggest a good film to watch and was surprised at all the details. Of course, noticing at the bottom something that says Gemini may display inaccurate information, including about people, so double check its response. That's good advice there. Google yesterday renamed its Bard chatbot after the new AI that is powering it called Gemini, adding that you can subscribe to get better reasoning capabilities. You get a more powerful Ultra 1.0 AI model with 2 terabytes of cloud storage. And Google already has a captive market in its large base of Android users to leverage as they find people who want the most capable generative AI technology that can discover new content on command and handle queries. Google claims the new service presents one of the lowest friction ways in the world to access AI and is available as a Google iPhone app as well. In English in 150 countries as at yesterday, and they intend to expand internationally to Asia Pacific, Latin America, and other regions. Already with Bard, the older version of Gemini, you can collaborate with AI to prepare for job interviews, debug code, brainstorm new business ideas, or create captivating images. According to CCCIO, that's the Gemini experiences, the Ultra 1.0 model is far more capable at highly complex tasks like logical reasoning, following more nuanced instructions, and collaborating on creative projects. Well, I'm using it for free for 2 months, and I think that's a good enough time to decide whether you really want it or not. My initial conclusion is $19.99 is expensive for a clever search assistant, and Google will argue that large language models like Google's Gemini family require immense computing resources to train, implying even greater costs that, of course, will have to be passed on to users. And if you add the enhanced coding assistance, specialized language tasks, or extremely sophisticated question answering, maybe that justifies the higher price tag. The other big question is, can you trust all the answers you get when you compare with your own research? The World Economic Forum has warned that misinformation and disinformation driven by AI is the number one risk factor, ranked by severity and impact, requiring proactive control processes. In other words, whatever Gemini tells you, find a way of confirming that it's accurate. The big issue for companies will be trust and accuracy. The big issue for regulators is how this tool can be used to concentrate markets further in fewer hands, and of course, privacy and safety issues for children and potential abuse. And good news in Germany, where we just saw the inflation rate, that's the consumer price index, compared to the previous year, was 2.9% in January 2024. This was a drop from 3.7% in December 2023 and 3.2% in November. The inflation rate has not been this low since June 2021. Looking at the details, energy products fell by 2.8% compared to January 2023, and after surging 4.1% in December, while food prices rose by 3.8% compared to the previous year. Goods increased in price by 2.3% compared to the previous year, and much lower than 4% in December year on year. Services rose in price by 3.4% within a year. Core inflation, which excludes volatile items such as food and energy, declined to 3.4%, also the lowest rate since June 2022. On a monthly basis, consumer prices were up by 0.2%. Restaurant services becoming more pricey, also partly due to the end of the temporary VAT reduction for food. Definitely good news for Europe's largest economy, as it seems to be losing its reputation for price stability and seeing a challenging period as global competition intensifies and demand for German goods cools. Lower inflation will boost domestic demand and encourage the European Central Bank to move earlier, perhaps on rate cuts, to further ease the economy. Third quarter revenue climbed at Ralph Lauren, better than expected 6% to $1.93 billion, while earnings per share of $4.17 also beat estimates of $3.54. Ralph Lauren shares closed up nearly 17%, closed 16.79% as they beat expectations for the 14th straight quarter, helped by robust holiday demand for luxury sweaters and dresses in the US and significant rebound in China. CEO Patrice Louvet said on a post-earnings call that intensifying holiday-related marketing campaigns, finding celebrities to model Ralph Lauren clothing, helped fuel the company's strongest quarter since the pandemic. Ralph Lauren added 1.7 million new customers in its direct-to-consumer business in the quarter and was attracting higher-value younger consumers, even as the more price-sensitive customers were also holding up well. China represents about 7% of Ralph Lauren's business and is home to its youngest customers. Some other key takeaways included, apart from China, decent showing in Japan, Korea, Germany, and North America, with Europe somewhat lagging due to inflation and all the geopolitical uncertainty. The company remains committed to achieve a 15% operating margin and open about 250 new stores over the next 3 years. Although there was significant growth in earnings per share and customer acquisition and momentum across all retail channels globally, North American the wholesale business declined materially despite mid-single-digit growth in digital wholesale. What we seem to be seeing in Q4 is the return of China, increasingly reflecting in Ralph Lauren and Arm Holdings. We'll talk about that later, pointing to a rebound that seems to be potentially stronger than the data suggests. And as we close, let's look at global markets. S&P 500 stock index basket of blue chips US stocks went past 5,000 for the first time ever, setting a record high even as a narrow group of companies, mainly big tech, continued to push the benchmark upwards. For the S&P, gains since the start of the year is now nearly 5%. On the other hand, the small caps index Russell 2000 is down 1.6% year to date and 16% below an all-time high that was last seen in 2021. Earlier today, Japan's Nikkei hit fresh highs, while most other Asia-Pacific markets were either fully or partially closed for Lunar New Holidays. The Bank of Japan Governor Kazuo Ueda told legislators that easy monetary conditions are likely to persist for a while, even if interest rates were no longer negative. The Nikkei 225 crossed the 37,000 mark for the first time in 34 years, up 0.4%. China, South Korea, and Taiwan's markets were short, while Singapore and Hong Kong traded only for half of the day. Also yesterday, UK chip designer Arm shares spiked by almost 50% after reporting higher revenues and improved outlook guidance, boosted by demand for artificial intelligence. And we also saw the shares of SoftBank Group up 15.29% today after the Japanese investment firm announced earnings that beat expectation. This was as its main investment fund continued to recover after record losses in the previous fiscal year. Later today, food and beverage company PepsiCo will announce earnings results before US stock markets open. Well, that's it from me on this episode of Global Business Insights. Thank you very much for watching. This is Bode Oshosami. Bye-bye.